Welcome back to the Bitcoin Layer. I'm Nick Bhatia. In today's episode, I will teach you about reserves held at the Fed and why they are so important for the financial system. Also, we will compare reserves to other types of money, including deposits and money market funds. Lastly, we will go into markets, a global macro update, and of course, talk about Bitcoin's price and valuation. Okay, let's start with this chart breaking down different types of money. The green line is the supply of Treasury debt that is available to the public. This is also known as the marketable Treasury debt. Think of this as debt that's not held by the Fed and other government institutions. So we have about 27 trillion in Treasury debt. Now, in the purple, we have commercial bank liabilities. These are the deposit assets of the private sector that are held at commercial banks that are chartered here in the United States. So that means that there are about $17.65 trillion worth of commercial banking deposits onshore in the dollar system. In orange, at 6.1 trillion, we have the total money market fund assets. Now, these are assets that are not quite like deposits. Deposits are unsecured assets held by the private sector. They are unsecured liabilities of the commercial banks themselves. And so that means when you own a deposit in the private sector, you at home or in your self-employment situation as a business, those deposits that you hold in your checking account fall into this commercial banking liability category. Money market funds, those are assets that you have as the cash line item in your brokerage account. Now, the 6.1 trillion in money market fund assets, these are balances that you have in your brokerage account. So imagine a Fidelity or a Schwab account in which you own securities, stocks, and bonds, and then you have a cash line item. That cash line item is almost certainly invested or swept into every night a money market fund, which is a cash substitute that is not a deposit. And that cash substitute money market fund is investing into other securities, notably Treasury bills and repo that is secured by Treasury collateral. And finally, in maroon, we have reserve balances held at the Fed at about 3.5 trillion. These are the reserve balances that are the deposits of the commercial banks themselves. So remember our layered money framework. You have in purple commercial banking liabilities, and in maroon, you have Fed liabilities. These are the assets of commercial banks onshore which hold reserve balances at the individual Federal Reserve banks. So a bank in Texas, for example, will hold a reserve balance at the Federal Reserve branch in Dallas, and that is the asset of that Texas bank and the liability of the Federal Reserve System. And that's how it ends up on this chart here. It's the aggregate balance sheet of the Federal Reserve System gives us this reserve balances. So we will get into the reserve function here in a second, but I want to give you the context of different aggregates in the monetary landscape. The Bitcoin Layer is sponsored by River. Make sure to check out river.com today or the link below in the description. River is our preferred place to purchase Bitcoin. Now, when you're buying Bitcoin, guys, there are several considerations. Number one, should I be using an exchange? Is the exchange custodying their own Bitcoin? Is the exchange using platforms to custody that we don't know? Is the exchange leveraging its Bitcoin for other purposes? Well, with River, we know that River does not use leverage of any kind. River also uses its own multi-sig solution so that your Bitcoin are not held by anybody else. So it's a very important thing to understand about what River offers. Now, River also has Lightning Network integration and a lot of other really exciting features. Go check out river.com today. Additional context here for you in this next chart before we go back to reserves and discuss the function of reserves. Let's talk about this money markets by type chart for 1 second. This is a money markets monitor that we have at the Bitcoin layer. Don't forget to subscribe to our free twice a week research letter at thebitcoinlayer.com/subscribe so you can stay up to date with all of this information. Now, in orange, we have once again the money market fund assets. But in black here, we have the Treasury bill supply. So I showed you previously marketable debt at the Treasury level. This is only the bills portion of that. So this is the total Treasury bills, including the bills that are owned by the financial system, including the Fed. This is at 6 trillion. In purple now, we have SOFR volume. So this is a repo indicator. This is how much inventory is being financed in the repo market. About 2 trillion every night is coming from the orange line, predominantly money market funds, and is ending up in SOFR, which means being lent to primary dealers so that primary dealers can finance their Treasury inventory. So what are the options for the orange line here? The options are T-bills straight up. They are SOFR, which is lending money to primary dealers secured by treasuries, whether bills or other coupon securities. And then finally, if they don't like those, the least risk option and the most liquid, in theory, option is the reverse repo facility, which is basically like the SOFR facility in general, as in being money lent to a bank and being secured by treasury collateral. But in the reverse repo example here, it is the Fed on the other side instead of primary dealers. So the options, once again, bills straight up, or repo secured by other treasuries, or repo secured by treasuries at the Fed. So the orange line has these three options. Now let's go back to the first chart and talk about the function of reserves. Now, you guys at home think of your deposits as your assets, right? That's your checking account. Those are your deposits. It's spendable money. That deposit is spendable money. You can pay down your credit card with it, or you can use your debit card directly to pull cash, or spend money with your debit card at a location that accepts it. So your deposit is a spendable money. The reserve balances held at the Fed are banks' deposits, and that is only spendable for a bank if wiring money or instructing money to settle to a fellow bank that also has a reserve balance. That's the only way reserves are used. They aren't even technically used to set lending restrictions, in that the Fed has a 0% reserve requirement. Now, the Fed and Basel from BIS both have banking restrictions on how much leverage banks can entertain, but it doesn't have to do explicitly with reserve balances. So why do banks hold reserves? What is the function of them? Well, think about the 17 trillion in deposits now here in purple. If company A sends $1 billion to company B, and company A and company B bank at different banks, the way that those two banks settle up that transfer is that bank A has to transfer $1 billion to bank B, and they use the reserve balances at the Fed to instruct that interbank settlement. So why are reserves important, and what is the function of reserves? Reserves are important for real movement in the economy between banks, or between the private sector's exposure to the bank and exposure to the Fed. And what do I mean by that? If a company wants to pull money out of a bank, It either has two options. It can transfer that deposit to another bank, and in that way, Bank A will have to transfer reserves to Bank B, or it can choose to buy securities, notably Treasury securities, with that. And so Bank A will have to send reserve balances to the Treasury and the Treasury's general account, which is another line item at the Fed. So, what are reserves used for? They're used for interbank settlement when a company or an individual transfers money to another bank. So, banks are needing reserves in that environment. Or if treasuries are purchased and then reserves are, in theory, destroyed in exchange for the Treasury now having access to that reserve. And the Treasury having access to that reserve, and that is known as the Treasury General Account, or the TGA. Now, in this next chart, I have the SOFR rate. We talked about what SOFR is. It's money lent into the primary dealer system secured by Treasury collateral. So what is the rate and where does it trade? Well, we have SOFR here in orange, and then we have the Federal Reserve's policy rates. So in green, we have the discount rate. This is considered the ceiling rate. Why? Because if a bank has trouble and it needs to borrow from the market and it can't find a lender that is willing to offer a fair rate that's around Fed funds, it will have to go to the discount facility, and that can be the ceiling. In purple here, we have the interest on reserve balances. This is a rate that banks can basically get risk-free from the Fed. In black, you have the federal funds effective rate. This is where we see banks lend reserves to each other if they don't have those reserves to make that interbank settlement that they need. If one of their customers moves a large amount of money, that's why a U.S. commercial bank would tap the Federal Reserve Fed funds market to borrow reserves for another bank. And then finally, here in maroon, we have the reverse repo facility. This is considered the floor, one of the floors in monetary policy, that this is the level that a money market fund can come in and get a minimum interest rate from the system secured by Treasury collateral offered by the Federal Reserve. So we should see SOFR trade in this range. And when does it spike up and spike down a little bit? When there's seasonal factors. So we saw on year end a little bit of a spike, and on quarter end a little bit of a even less bit of a spike, and it's come down a little bit here back to the range that we know SOFR to trade in. So at the Bitcoin Layer, again, thebitcoinlayer.com/subscribe, and make sure to follow us as well on social media and on your favorite audio platform as well. We are watching metrics like this to make sure we are watching the financial plumbing. What is actually going on in banks? Don't be fooled by any narratives that there's a banking crisis unless specific metrics like SOFR or the broad general collateral rate are moving. The next portion of the video, I want to talk about the economy real quick. Let's look at two charts on the housing market. First, home sales. This is the sum of existing home sales and new home sales. We had seen a large decline over the last year plus. Notice that there has been a modest spike in home sales here. So as the stock market has done really well, we're looking for explanations. One of those explanations is fiscal spending and deficit spending. One of them definitely is the housing market. On this next chart, we have residential home prices by two metrics. One is the Case-Shiller in orange, and then purple is the Federal Housing Administration's index, and both of them in 5 to 6% year-over-year gains. And notice the Case-Shiller dipped to a year-over-year contraction last year and has bounced significantly. So home sales up, home prices up. That drives the wealth effect up. The wealth effect, of course, is this economic idea in which if your stock market portfolio and your real estate home portfolio is going up in value, you feel wealthier and you spend more into the economy because you're more comfortable in your position. If you need to, you can sell assets. So The wealth effect driving all parts of the economy here, driving spending. What comes first? Is it the stock market that moves first, that moves home prices? Is it the economy that moves the stock market? Is it home prices that moves the economy? It's difficult to tell, but we watch everything and look for correlation. We'll get to correlation in a second and why it's so important for asset prices. Let's look at last week's releases of ISM services and manufacturing. Services here in orange, manufacturing in purple. What do we see? Over the last several years, we had a decline in manufacturing. That has bounced significantly over the last 1 year. We were below 50 for several months, which is in contraction in manufacturing. We're finally above 50. This bounce has correlated with strength in the economy, strength in the stock market. So manufacturing sector doing very well over the past several months. On the other hand, services not too great and seeing lower highs, as you can see in orange. So still in expansion territory here on services, but not looking as great as it once was. So something to watch out for. Neither one of these indicators is pointing to a recession. However, we have to keep watching manufacturing and notably services, which dominate the US economy. If services fall below 50, which it did briefly at one point last year, it will be a red flag and something to watch for. So we'll continue to watch this. Now, why is ISM so important? This next chart will show you why. Here on this chart, we have manufacturing ISM, which we know now is back above 50. And in purple, we have the year-over-year return of the S&P 500. And notice the correlation here over the last couple decades. It's very strong. And what has happened of late? Stock market bouncing huge and leading the economy higher. Again, the wealth effect. Stocks do well, people spend, manufacturing activity goes up. Which comes first, the chicken or the egg? This is part of our study in global macroeconomics, is trying to determine the causation. But us getting up here and confirming the causation would be naive. Instead, we look at every component and try to understand what is moving first and why. Right now, we can see in this cycle, stocks move first and manufacturing followed. Housing has also followed here. So things are going well in the US economy on the broad aggregate basis based off of these housing market charts, ISM charts, and of course, equity performance. Let's shift gears to central banking. We know Switzerland cut rates. We've talked about that at the Bitcoin layer. Next looks to be Canada, although several central banks are expected to cut rates this year. The sharpest downward slope here is in the BOC. So in Canada, we are expecting interest rate cuts to come sooner than later. For the Fed and the ECB, we'll probably see them later this year, at least after Canada, but we'll continue to watch and continue to post this chart for you. Zooming into the Fed specifically, when are those cuts expected? They have been pushed back just a bit. So our first cut is now expected somewhere in July. We at the Bitcoin layer have expected it in June. We've held that call since the fourth quarter of 2023. We're sticking with June for now because we have a bunch of data, including CPI this week, to instruct the Fed. The Fed doesn't seem eager to want to remove cuts from the conversation. So we'll take the Fed's word for it that they are going to be cutting rates this year. We'll guess in June right now, and we'll keep our eye on it. And we see now this whole 1% wave of cuts. It's not expected by June, September, or even December. It's pushed now back into the first quarter of 2025. So cutting cycle significantly priced in, but pushed back slightly. Next chart here, gold. The shiny metal is doing extremely well this year. We have a multi-year breakout going on in gold. Gold looks good and set to hit $3,000 here over the next year or two. No time horizon there, but based off of this several $100 consolidation that we had on gold, really between $1,800, $1,900 and $1,100. So call it $800. we can expect that to be tacked on to the top of the breakout, which was around 2000. Just a classical charting technique there. And it might take years to get there, but we do see the path of gold. It should head much higher now on a repricing event as we have had a wave of inflation. And when all of this fiscal deficit spending is said and done, we will probably have an aggregate 50 to 100% ratchet up in the aggregate price level across the economy. That's what you get when you get inflation compounding at 5 or so percent for several years, as we will see here in the US, inflation very high for many years. And even if it trends back down to 2%, in aggregate, this price level has gone much higher. Gold should reprice up. We are now seeing the dollar strength come into play. Foreign currencies devaluing against the dollar. Foreign governments stockpiling gold as a hedge for their balance sheet. All of this is representative here in the gold price. We should watch this trend and look for it to continue. We will, of course, be watching the dollar very specifically and how that is affecting the Chinese yuan, the Japanese yen, and other emerging market currencies. Finally, here on Bitcoin, we promised you Bitcoin analysis, both on price and valuation, and here it is. This morning, Bitcoin trades above $70,000 once again. It has been consolidating around $70,000 for several weeks now. Now, the Bitcoin price basically rests at its all-time high, but what we are watching most closely is our favorite valuation metric. Go check out our video on what is Bitcoin realized price for an explanation into this next metric. But in purple here, we have on-chain cost basis. Our realized price has gone very strong here over the past few months. Bitcoin is changing hands. That's what this means. It means Bitcoin is moving on the blockchain at much higher prices, at prices that are currently $60,000 to $70,000. These coins that are being moved right now on the chain have last moved much, much lower. So in the range of 40,000 or 20,000 even. And so coins are being moved at a much higher cost basis. And we can assume that the cost basis will hold as a good base for Bitcoin as it has throughout its entire life. As people want to be in this growing asset, they basically hold the line at realized price. So the higher realized price goes, the higher the cost basis goes of the network, and the higher the base of Bitcoin can go. It also means that the valuation relative of the market price to the realized price then can stabilize and give the market price room to grow even further. What do I mean by that? In green, we have MVRV. This is the ratio of market price in orange to realized price in purple. So this is a valuation metric. It's a multiple. You guys think of PE ratios, price to earnings ratio. What is the price based on the earnings? Well, what is the price based on the cost basis of Bitcoin? So the higher this ratio goes, the more expensive Bitcoin is. The lower it goes, the cheaper it is. And a ratio below 1 is basically a steal in a growing protocol. And that's what has happened throughout Bitcoin's life. As we see, Bitcoin's price dipped below, the orange line dipped below the purple line in 2022 at the end, when Bitcoin was trading below 20,000. That was, as they say, a generational buying opportunity, because you very rarely get the opportunity to buy Bitcoin market price below what the aggregate cost basis is of the network. And now we should expect MVRV to trade back up to several multiples of 1, meaning that right now we are at about 2.5. So the market price of Bitcoin is about 2.5 times the realized price. This got to 4 in the last cycle, and it could get back to 4. It could potentially get much higher. But we want to see MVRV stay in a sane environment, not get insane. Insane would be getting to levels in the 5 to 10 range, which would mean you are getting to a price which is much, much higher than the on-chain cost basis, leaving immense room for profit taking. Immense room, and that's the key here. That's what will pop the Bitcoin bubble each time. Of course, it recovers after several years. We've seen that in 2015, 19, and again in 22, Bitcoin recovering these massive, massive drawdowns to new all-time highs within a couple years. But those only happen when the MVRV gets out of hand. And when the MVRV gets out of hand, it means there's too much unrealized profit. And so people will take it and drive the price down. So we will be monitoring MVRV this entire bull market, and we are in a bull market, and we will be watching it for you to look for signs of Bitcoin being overstretched. Do we see it right now? Absolutely not. We see Bitcoin trading between 2 and 3 on MVRV. That's in a normal bull market environment. Thank you guys for watching today. Make sure to subscribe, and we'll catch you next time. Special thanks to River for sponsoring this channel. Purchase Bitcoin without any fees when you use River's DCA feature. River has become our trusted source of accessing the Bitcoin market because they don't use any third-party custodians. This is a very, very important thing to understand. River is not using another company to store the Bitcoin for them. They have their own multi-signature solutions, which means that they have designed their own way to make sure nobody else has responsibility for the Bitcoin for the time that you have River hold your Bitcoin for you on their platform once you have purchased it. So go check out river.com today. Thanks for sticking with us. As always, at the Bitcoin Layer, subscribe to our channel. Subscribe to our Substack at thebitcoinlayer.substack.com so that you can follow along our latest research and analysis.